September 2008. A bank with 158 years of history collapses overnight. $600 billion disappear. Retirement accounts turn to dust. Millions lose their jobs. But what if I told you the real cause started with a lie so simple it could fit on a billboard? Why rent when you can own? Now come back with me a few years. United States, 2002. The country is still hungover from the dot-com bubble burst. The September 11th attacks just hit the economy hard. Wall Street is nervous, unstable, but there's confidence in the air. The Federal Reserve steps in with a clear solution: slash interest rates to nearly zero. Done, cheap money, easy credit. And suddenly, the nation's favorite pastime is no longer baseball. It's buying houses. Congratulations. You've just been approved for $500,000. But I make $40,000 a year. No problem. Adjustable rate. Balloon payment. Ninja loan. No income. No job. No assets. No problem. In the early 2000s, home ownership wasn't just a roof. It was the American dream. Stability. Status. The promise of a safe suburban life. And the message repeated in ads, billboards, and seminars was always the same. Why rent when you can own? Banks agreed. In fact, they agreed so hard they started throwing money at people like it was a game show. Everyone seemed to win. That's when subprime mortgages enter the scene. Translation: loans for people with bad credit, unstable income, or a vague relationship with money. Bad credit? No credit? Living in a van? Congratulations. You just qualified for a luxury condo. What if I can't pay? Not your problem. If you default, the house will be worth more later. It was a housing gold rush, a collective fever. Everyone buying. Prices skyrocketing. Your neighbor's house doubles in value in 6 months. Normal. Fast food workers and baristas with $5 in their account getting approved for mortgages. Just another day in the 2000s. And the rules got thrown out. Risk assessment was too slow. Requiring a down payment was outdated. If you had a pulse, you had a loan. People bought houses like instant noodles. Banks printed debt like monopoly money. Brokers made commissions faster than they could say, bubble. Behind all this noise was blind faith. The belief that housing prices always go up, because they always had, until they didn't. Beneath the granite countertops and pretty facades, there was rot. These mortgages were bad, really bad. High risk, little verification, fragile debt. But Wall Street had a trick. They bundled these bad loans, packaged them nicely, and sold them as safe investments. Mortgage-backed securities were born. Bad debt, gift-wrapped. And to make it even more trustworthy, rating agencies gave them top grades. Body A. Important detail. These agencies were paid by the same banks selling the packages. It's like asking someone to review a restaurant knowing they only get paid if they praise the raw chicken. Behind closed doors, many people knew. This was garbage. But Wall Street didn't stop there. They took these unstable packages and mixed everything into even more complex products. CDOs, an extra layer of confusion over an already serious problem. Financial alchemy. Garbage becomes gold on paper. Not everyone bought it. Some strange, skeptical investors read the fine print and saw the bomb. They asked the forbidden question. What if we bet against this? The problem was simple. There was no way to do it. So they went to Wall Street and asked for something new. You want to bet against the housing market? That's cute. Fine. We'll create insurance. You pay a monthly fee. If nothing happens, we keep the money. If everything collapses, well, that's never going to happen. Credit default swaps are born. Insurance that pays out if the debt breaks. The insane detail? You didn't need to own the debt to buy the insurance. It was like taking out life insurance on your neighbor's grandmother and rooting for her to fall down the stairs. The entire system becomes a Jenga tower made of lies and leverage. Each block, a bad mortgage. Each floor, a bigger bet. And at the top, record bonuses. Who needs ethics when easy money flows? Warnings are ignored. Regulators doze off, and those in charge are too rich to care until the floor starts cracking. At first, almost no one notices. A missed payment here, a foreclosure there, an empty condo in Las Vegas, until the unthinkable becomes a headline. Housing prices are falling, but houses always go up. Not this time. In 2007, the castle starts crumbling. Subprime mortgages implode. The safe packages explode. Banks realize they're sitting on radioactive waste. ALA? In practice, financial plutonium. We can't sell this, so it's worth zero. So we're screwed. Panic spreads. Hedge funds bleed. Banks announce billions in losses. And then, September 2008. Lehman Brothers collapses. 158 years of history. No bailout, no hero. If a bank like that can die, anyone can. Banks stop lending to each other. Credit freezes. It's like unplugging the global economy. I need a loan to make payroll. No liquidity. What does that mean? It means it's over. Companies close, families lose homes, retirement accounts evaporate in real time. This isn't just Wall Street, it's real life on fire. And it doesn't stop in the United States. Banks collapse in Iceland. Markets crash in Europe. The entire world seizes up. The Great Recession begins. The system is saved later, with trillions, with public money. But trust, that never fully came back. Because in the end, the 2008 crisis teaches one simple, uncomfortable lesson. The system didn't break. It was protected. What broke was everyone who believed in it. If you want the next story in this style, comment the topic below and subscribe so you don't miss it.